Portfolio Builder members, today is November 11th. Happy Veterans Day. Today's update will review all our open positions and the top news we've collected over the past 24 hours, actually 72 hours all weekend. Start off with a quick little presentation about what we do, then we'll jump into today's trade alert and then finish up with all the hot news that's come out. Daily income trade alerts at noon Eastern. Our goal is to deliver 1% a month. We've averaged 1.35%, and we've only had one losing month with a negative 1% return. So if you're a conservative investor who wants to protect your nest egg, this is how we do it. We trade the SPY ETF every Monday, Wednesday, Friday at noon Eastern, taking advantage of 3 option expirations per week. Emerging markets gives us access to Asian equities. There's 1,000 stocks in that ETF. 2 of the top 10 most valuable companies in the world that are not in America are held in that emerging market ETF. We trade that Tuesday at noon Eastern. Then on Thursday, we play the bond market with the 20-year Treasury on the TLT ETF, and then the gold miners with GDX. Currently, we've been betting down on TLT and GDX, which has been profitable over the weekend. Our emerging markets did pull back a little bit today, but I'm not worried about it. Alibaba just came out with insane profits from their big Amazon Day ripoff. They call it Singles Day, and it did some incredible amount of billions of dollars in the first 30 minutes of going live yesterday. And so that's our allocation per $75,000 invested. Our goal is to generate $750 a month of profit, and we've averaged just above that, so closer to $1,000. Good morning, Ron. Now, if you do have a smaller portfolio, you can follow it with very similar results. This costs $30,000 to build, has a very similar risk-reward ratio, and for the time being, your bonds and gold are quite correlated, so you will get the same basic return with a little bit more risk. So this portfolio has actually outperformed this setup, but it's had greater volatility, so it comes at a cost. Target income is again 1% a month, and our average return has been 1.35%. What's important is that we're able to generate profits regardless of what the S&P 500 is doing. Go back to that December crash of over 16%, we made 1%. January, February, we pulled in 2.2, 1.7. March, April, May, we bounced between 1.2 and 2.7. June was our best month to date, 3.2. July was our only loss. This was being defensive against a trade deal breaking down, and we will always play it safe and precautious. There was no reason to think a trade deal would be bragged about after that Osaka meeting in July, but sure enough, they came out and said they had a farming agricultural purchase deal. And then in August, we didn't have a deal. They made all these tariff threats for October, December, and now they're back to saying we have a trade deal. So we'll see if there really will be one or not. Currently, we're long equities and then short those safe haven assets. Our portfolio is simple with 4 ETFs, and it's extremely diversified. It's all you'll need for your retirement. Income and safety, not growth or speculation. And what's important is the stocks and bonds protect one another. Typically, when one goes down, the other goes up. That's how we're able to get such smooth returns and low volatility. Simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. And if you do click in the description box below, you can sign up for our free educational webinar this Thursday at 2 Eastern. So I'll just show you right here is that link. Also, I'll point out that you can apply for our advisory right here. We want to make sure you qualify. We have every trade alert ever issued right there at that link. And we have our track record if you want to go through it with a fine comb at that link. Everything is open for the public. Complete transparency. Also, we do offer free portfolio consultations. Call Dean at 505-322-7515. All right, here's our disclaimer I'll leave up for a second, and then we'll jump in today's trade alert and then finish up with the top news. All right, so we've generated profit in 3 of the past 5 SPY trade alerts in our portfolio, a gross profit of $3,570. And the market would lead you to believe it's rainbows and puppy dogs right now. And so we'll take a look at why we're most likely coming towards the end of this free money parade in the next 2 years or less, and how the U.S.-China trade war can expedite that timeline. So the previous trade we entered on Friday when the SPY was at 307.90. And today it closed out at 307.99 for a gain of 9 cents. Our option caller cost a debit of 16 cents and brought in a credit of 3 cents to close it out for a loss of 13 cents. Overall, we lost 4 cents a share, or negative $68. If we look at the previously closed out trades, I'll zoom in on that for you. We've done well. $986 in profits on the 11.8 trade, negative $884 on the 11.6 trade, $1,734 on the 11.4 trade, and $1,802 on the 10.31 trade. So these are just the most recent trades we've closed. This is a look at the Trade Alert email today. Again, here's your trading schedule. All trades are at noon Eastern. And here's a look at our open position. So this is something I've added to our daily update, so you can see exactly what's going on in all of your positions without having to do any hard work. So on 11.5 we went long emerging markets. This position is down a little bit, but I do expect it to pop up. Alibaba had a record day in sales, and China looks like it's getting ready to start increasing its credit and push their stock market higher, especially if this trade war phase 1 deal really gets signed. Now, if the deal doesn't get signed, all bets are off, and we're back to being short equities and long safe havens. So we did get a little pullback in this position, but we are long, and I expect it to pop up this week. There's been some pretty crazy violence in Hong Kong. First man down, or a child down, got shot. Another lady was found dead who was in the ocean. All kinds of nasty news coming out of Hong Kong today. So I think that has potentially put a little bit of a sell-off in the futures market overnight. But we have been seeing stocks start to buoy back towards that 309 all-time high. TLT, we're betting down. Now it's interesting. We can buy the TLT and then use that to leverage it for a covered call that's in the money, and then to buy a put option that's in the money. So the math on this trade is that we entered this trade on 11.7 at 135.56 on the TLT. Now currently that has dropped in value by about 60, or rather 59 cents. So even though the TLT has gone down, you can see the option caller, because it was an inverted option caller, has actually gone up in value. So we're up 63 cents on the options, which again, we bought multiples of 100 shares of the TLT. We sell the in-the-money call, so that just means the call option strike is below the trading price. And then we buy the in-the-money put. That means it's above the trading price. So it's the opposite of what we normally do. And so right now we're up $482 with a profit of 13 cents a share on the TLT. Now I don't want to be short the TLT for very long. The big picture is that the Fed is trapped, and they're going to have to keep cutting these interest rates to fund the U.S. government. There's no way around it. We'll take a look at that a little bit in today's update, but really, if you want to get the big picture correct, the big macro, and really understand what's happening in the next several years and how there's really no way to escape it, join our webinar this Thursday. And again, click in the description box below to sign up for our webinar. I'll be going over that in great detail. GDX is very correlated to the bond market until inflation starts to perk its head up. Right now we're in a low inflation environment in the U.S., not such the case in China, whose CPI has been going up very rapidly because of pork prices mainly and food prices skyrocketing. But again, with a farm deal, that could relieve pressure on their food prices and potentially pull back their inflation rate, which I think will give them what they need to start increasing their credit, which is what is holding back emerging markets most likely right now. We did the same trade on GDX, and again on the TLT and GDX, my expectation is the SPY will break out to the 315 to 330 range. This will be from a phase 1 trade deal that currently could happen December 3rd or 4th in London. Now this is all up in the air, and right now we just have to play along with their narrative. But after it does get to that range, I think the sell-off in gold and the bond market will come to a halt and then start to gradually push higher. And that's just because we understand what these central banks are doing. There's some 30 central banks dropping rates in the next 2 months, and primarily all printing money. Now, we're not seeing China print a whole lot of money right now, but we are seeing Europe and the US print money at a speed that's very close to what we saw back in the 2009 crisis. Now, this is with stocks at all-time highs, so that is going to be very bullish in equities, and that's why with those two things combined, we basically want to be long stocks and bonds as we see the banks are trapped to slowly lower these interest rates. So here's a breakdown of our returns. Now again, you're trading Monday through Friday at noon Eastern. These trades take 30 seconds. They're very easy. And the goal is not to outperform the S&P 500. Our goal is to deliver consistent profit with extremely low drawdown. And you can see our only loss was in July with a negative 1% return. We're down a little bit in November, but I do suspect that will quickly change as our equity positions deliver profits and our short TLT and GDX positions are just getting started. And so we have had to make up some lost ground with a 99th percentile jump in bond yields that occurred in the last week. So our put options did kick in and save the day on that position. Here's a look at our returns on the SPY trades separated from everything else. We're up 1.2% in November, 10.7% year to date. If we look at the emerging markets ETF and the plays we've done on Tuesday, this portfolio is up 20%, but it's done it with a lot more volatility. So that's why it does represent a smaller piece of our total portfolio if you have enough capital to follow the whole strategy. Now, if you want to get more risk and more reward, you can get rid of the SPY as it's very correlated to the emerging markets ETF. Now, that's not always the truth, but right now it certainly is. If the US-China trade war were to escalate and we started putting more tariffs on China and sanctions, we might be in a position where we're betting up on the SPY and down on emerging markets, depending on what China does to retaliate. Meanwhile, our bond portfolio has delivered at least half our profits this year, and I think it has plenty of room to travel higher on the TLT in the next 12 to 24 months as we push rates towards zero, most likely. And this is due to the global slowdown that really puts us in a tough spot. Number one, we got China slowing down. That's been the growth engine. They're having high levels of inflation, so they've been reluctant to increase the credit. And then on the other hand, the U.S. government's creating so much debt that if the Fed were not to intervene and buy up this debt and artificially push bond prices higher by lowering interest rates, well, then the U.S. federal government's budget wouldn't be funded, and that's just not going to happen until they really run out of ammo. So we'll take a look at how much longer the Fed can keep this up in a minute. Here's our total return, 14.81% in 11 months. And this is the breakdown overall per portfolio. Now we did review this, so I'll skip through it. Here's the new trade alert. First part is to buy to close your 309 call from last Friday, and then sell to close your 307 put. So that gets you out of the previous trade. Then we're going to roll it over to the next trade. nothing's changed in terms of the strikes. It's a relatively tight option collar that protects us from you-know-who issuing a tariff tweet, which could send the stock market much below 300 overnight. So we don't want to be exposed to that kind of risk. With this trade, we have a 309 call, so that means we're not going to enjoy any profits above 309 on the upside for us. But on the downside, if the SPY were to crash, we'd get to keep that 47-cent credit that we collected from selling a call option, probably get a 98% profit on that. And then our long put at the 307 means we'll walk away with at least $307 a share for every share of the SPY we have. So one put contract protects 100 shares of the SPY. Now, my prediction is not that the SPY will fall down, but if something unpredictable happens, that has our back and allows us to create a very passive trading strategy where we don't have to worry about anything. An atomic bomb could go off, we'll still get 307 per share because we bought that long put. Here's the risk to reward ratio. We can make up to $107 a contract to the upside, and to the downside our maximum, or rather it's the opposite, our maximum risk is $107 and our maximum gain is $93. So that's today's trade alert. This is a little bit of what you'll learn in our webinar Thursday, but this is the big picture that a lot of people don't understand how important this is. Let's see if we can get that little screen to change here so we can see it clearly. And so what we're looking at here is the federal funds rate. People don't seem to know in general just how powerful this tool is. And so if you've been looking at the last two stock market crashes and then thinking to yourself, well, hey, I'm up big, but if there's a stock crash, I don't care because it's only going to last a year and then it's going to rebound much higher. If you think that's the kind of environment we're in, I've got news for you. The only reason we've had this 40-year bull market, not 10-year, not 20 years, really it's been a 40-year bull market, is because we've went from extremely high federal funds rate, 20%. That's how much it used to cost to borrow money. And that will get all malinvestment out of the economy. You got to believe that you have a very profitable business plan to borrow at that rate. And so what's happened? Well, they've slowly dropped those rates for the past 40 years. And now they're out of ammunition. Every 1% that has been dropped, at least in the last decade, has been valued by some famous economists as over $1 trillion of credit. So we look at QE and say, okay, they've put $4 trillion into their balance sheet, monetizing the U.S. government's debt. But every percentage point on the interest rate is even more powerful. And so the last decade, they've had interest rates near zero, which is ripe for creating malinvestment around the world. And sure enough, we've had lots of it. What can they do now when we do have a global slowdown, which we clearly do? What are they going to do now when we have record deficits and too much bond issuance to sell? Well, they have no choice. They have to drop these interest rates to keep people holding their bond position. If the bondholders believe these interest rates will go lower, they're not going to run for the exit to get rid of these 2% yielding bonds that are below the Fed's target for inflation. So it's pretty much a guaranteed loss. So the only thing that's holding the bond market together right now is the belief that these rates will go lower and drive bond prices higher, and that the Fed will bail out the banks by purchasing these bonds at a higher price. So instead of buying bonds for high yield, people are buying them for a capital gain. And so how close are we going to get to zero before the market decides to sell in mass exodus? So that's really what is headed into the cards for us. And so most likely the period of time you guys are going to be living in for your retirement is going to be much more like the 1960s through the 1980s, where you can see in 1955 they tried to jack up rates. We got a stock crash. It went back towards zero. Tried to jack it up again, got another stock crash. And then inflation came roaring in, and they had no choice. They had to absolutely raise these rates. And look what happened. From 1965 through 1980, you essentially had a 15 bear market in both stocks and bonds. That totally ruins the whole financial engineering of how our system's supposed to work. And so what are they going to do? They're probably going to bobble that around 0 to 2% for the next several years, print a ton of money, and try to push this recession or potentially Great Depression as far into the future as they can. So that's why we want to play the bond market to the upside as soon as this SPY does probably levitate much higher. And that's why we want to own gold, even though it's having a pretty sharp sell-off right now. Okay, so that's the big picture. We're running out of ammo. We're at the end of the rope. There's nothing they can do about it. What could save it? Okay, here's what would save it. If we could somehow get GDP above 3% and get the U.S. government to stop creating such a huge amount of deficit, then you could potentially pull out of this without a huge depression or recession. But the problem is the only way our country is able to print a positive GDP is by creating a greater amount of debt. So we're actually borrowing money at a rate that's faster than our economy is growing. So that obviously doesn't work for very long. Think of a teenage girl who's got $1,000 left on her credit card. That's basically what America is right now. Okay, so let's look at the big picture in terms of the news now. So I've organized the news to come in basically 4 sections. First, we'll look at the most important headline, which is shocking and graphic and very sad. First person dead in Hong Kong, or at least on the streets in the middle of a protest. The next section is the charts. After that, I go into China-related headlines, then U.S.-related headlines, and then political headlines. And so that's really the mixture of content that I'm following on a daily basis to predict these markets. Okay, so here's your SPY ETF, flying high, 309.38 was our high. My target range with the phase 1 trade deal is between 315 and 330. And at the rate we're flying up, I do think it'll be closer to 330 before we get towards a topping. Emerging markets, my target is to go beyond $52 a share. That was the most recent high. And so I think with a phase 1 deal that can easily do that if China does start to ease its credit restrictions. Now it's questionable why they're being so strict about not increasing their money supply and credit right now when they're clearly having a slowdown. In fact, we'll see some bad news about China's growth in a minute. Here's that sell-off in the TLT. So I think this could sell off quite more rapidly with the phase 1 trade deal. So we will be very cautious of being long the safe havens if this phase 1 trade deal does seem like it's going to take place. Now, it's really hard to predict if it will. Of course, if we look back at history, it would tell us there's no trade deal coming, and this is just trying to prop the markets for the time being. GDX, same picture, big time. Long term, we want to be long gold because we can see what the central banks have to do to support their governments, their debt, and this global slowdown. Short term, again, I don't want to be holding the loss when we get some short-term volatility from a potential phase 1 trade deal. So we do have those 2 positions very safely protected to pick a down move. Hong Kong's exchange rate has jumped up a little bit, which probably making Kyle Bass heavy, so I'll start watching that more closely. This thing has barely moved for quite some time, and billionaire Kyle Bass is all about trying to short this currency. So we may follow his suit in the boot camp as we watch this continue to get more violent week after week. And this could be the canary in the coal mine. The U.S. has said that it needs to be a peaceful resolution to Hong Kong, and this might just be the story, the propaganda that can be used around the world to get all these countries to really put pressure on China. So I'm concerned about that, but this could be a good trading opportunity. The other trading opportunity, which actually could have made you a lot of money over the past 2 years during this trade war, would have been shorting the Chinese currency, which their reaction to tariffs has been to devalue their currency. And this is causing all the other emerging markets to devalue their currency, which is pushing the dollar higher and making it harder and harder for them to service all the bonds they've sold, which are denominated in dollars. So their currencies are losing value, and that makes their debt relatively more expensive if they're trying to pay for it by converting their currency into dollars. Here's a look at gold selling off. Probably 1,400 is a fair sell-off for gold that I would expect in the current environment. Maybe down to 1,300. I don't think it'll go much lower than that. And again, we're looking for the catalyst to flip the switch back, and the catalyst would be stocks getting overpriced. So somewhere around 315 to 330 on the SPY is when I do expect to flip our option collar to be bullish on gold and on the bond market. Crude oil, keeping a close eye on that. It's at a healthy level. If it were to get too expensive, I would get precautious in our bond position, as that would push inflation up. And if we start to see it tank in terms of price, then we want to get bearish on our stocks. This is the best leading indicator for the bond market, is that German 30-year yield. And it has popped above zero, but I think this is a dead cat bounce as we see China's GDP is crashing. And even though people will say, oh, well, China's growth is still better than the U.S., what's more important than just the current speed of its growth is the change of speed. And so it's actually de-accelerating extremely rapidly. So it's like a ball falling in air. It hasn't hit the ground yet, but its trajectory is quite clear. And so it looks like China may have its first GDP print coming up below 6%. And this is coming from above 14% 5 years ago and above 30% 20 years ago. And they have misallocated more capital than anyone on the planet, anyone in history, building 65 million houses that no one lives in, airports that are $14 billion of investment that no one flies in, railways that no one can afford to travel through to London. It's just a mess. And while it's impressive, and it has been the growth engine of the world, we're seeing that they are coming to the end of their credit limit as well. Here's the dollar. Again, with the Fed dropping rates 3 times, printing some $280 billion to monetize U.S. government debt, sweep it under the rug into their balance sheet. They're doing $180 billion a night of repo, just more free money for the banks, and yet the dollar's near an all-time high. So that just shows you how problematic currencies are around the world. And so despite this, these dovish moves by the Fed, our dollar continues to remain strong. U.S. Vice Pence Chief of Staff is very confident Phase 1 trade deal with China will be signed before the end of the year. And so I guess the best argument for this is that Trump wants to get reelected. And if you go back through history, the only time people don't make it for the second election is the president has a recession going into the new election. So I'm sure they know that very clearly and will bend over backwards to try to prevent a recession in the next 12 months. Now, the other catch to that is China knows this as well. Is that why they're dragging their feet to create more credit and to try to slow down this trade deal, keep pushing on more and more demands? Maybe they want a recession. China's shadow banking contracts for the 7th consecutive month. So we can see their shadow banking has not been adding credit since the trade war began, really. And so this is just saying that perhaps it's because of concerns about inflation from the food prices skyrocketing. Perhaps it's just prudence to try to get all the malinvestment out of their banking system. Their real estate construction companies are filing bankrupt left and right because, once again, they've built more than they need. And so now that's how they come up with this brilliant idea for the Belt and Road Initiative. In a minute, we'll look at all these countries that are in massive debt to China because of that project. And again, they're looking at potential 5.9 GDP for Q4. That will definitely scare the markets. Meanwhile, China is dropping prices, and this could be relative to their currency devaluing. So these exporters maybe just kept their prices the same, but the drop in conversion rate has pushed the relative price much lower. China's credit creation has collapsed. You can see it is very low. They're still adding some money to the economy, but it's much less than we've seen in the past. And you can see $618 billion versus periods of time where they're doing trillions, which is insane to think of numbers that large. Hong Kong dollar overnight spikes 50 basis points. So Kyle Bass is betting that China will just give up on the Hong Kong dollar once enough pressure has been applied. It's quite a complex explanation of how leveraged Hong Kong is and how its relationship to China has become a problem. So that's something you can just Google Kyle Bass and then probably Real Vision or Bloomberg, and you can get his whole spiel on why he thinks the Hong Kong dollar is going to collapse at some point. So you can play the futures market to profit from that. If he's right, there's an insane amount of money to be made. Now, what's interesting about this trade is there's very little risk of it tightening. So you can put on these future contracts and risk very little. And if that does play out, a huge profit potentially gained with perhaps relatively low risk, just the spread on the futures contract. Whereas if you try to play the bet on the China, which has been a profitable trade over the last 2 years, they are manipulating that exchange rate up and down, making it much more difficult and risky to put that trade on. So we've waited to do that until we see what happens with this trade deal. Hong Kong protesters seeking to pool their economic leverage turn the smartphone app to keep their money out of the pockets of businesses perceived to side with Beijing. So this is just getting more ridiculous by the day. And I think this could be what breaks the straw that breaks the camel's back. We'll see. Pompeo is trying to drive a wedge between Chinese people and the CPC by severing the bond between them. Let me be clear, the CPC, as our country's ruling party, has been deeply trusted and warmly endorsed. Pompeo's comments are extremely dangerous and unworthy of U.S. Secretary of State. Pork hyperinflation sends Chinese consumer prices soaring the most in 7 years. So probably a whole nother story on what on earth went wrong with their pig herd. Apparently African flu swine destroyed some 75% of all of their pork. And so this is the primary cause of their inflation, which also combined with not purchasing U.S. agricultural probably has applied more and more pressure to their CPI. So this could be substantially relieved with the U.S.-China trade deal. There is no way China's comprehensive strength can surpass the U.S. in 50 years. For the U.S., the risk of aggressively suppressing China's rise is far bigger than dealing with future China. The U.S. should make its China policy based on this judgment. Zero Hedge says, how much tech can China steal in 50 years? Longview says, China is moving up the value chain. They have telegraphed this in their Made in China 2025 initiative. First it was textiles, furniture, white goods, and tech components. Next it will be heavy machinery, pharma, and software. This is just a taste of what the next decade holds. Boeing is next in this example. They're already in the process of knocking off Caterpillar and Deere. Though not a U.S. example, the case of Siemens is instructive. The company partnered with China National Railway in 2005 to build 60 passenger trains worth $920 million. Siemens constructed 3 trains in its German plant, and 57 were built in China's plant in Tangshan. 4 years later, the CNR received a massive $5.7 billion contract, and Siemens received a $1 billion contract to supply components for it. Today, China sells $35 billion in railway infrastructure annually, more than Siemens, Bombardier, Alstom, and GE combined. Kyle Bass, Hong Kong holders would have to be crazy not to freely convert to the US dollar given the enormous leverage in the Hong Kong system, coupled with the severe economic decline that Hong Kong is experiencing. Even Chinese economists agree. Here's the countries that are in debt to China. Meanwhile, China has created more money and debt in the last 30 years than any civilization in history. Probably all civilizations combined together in all of history wouldn't even get close to how much debt they've created, trying to keep their GDP positive. And more importantly, they're trying to keep several hundred million people employed out of their 1.4 billion population. So that's a tough thing to accomplish for very long. Okay, now we're moving into U.S. news. Every time the 30-year Treasury spikes for too long, we get a sell-off. Those 30-year yields, once they get way above the expected inflation rate, turn into a guaranteed profit. The banks turn that into a leveraged trade and make a ton of money with it, and love to take that trade. So most likely we'll see eventually these TLT drop to a point where it's too attractive and we get a nice reversal. And that's the basis of our entire strategy, this relationship between the stocks and the bonds. Now with the phase 1 trade deal, I do suspect those yields will pop much higher on the bonds and the S&P 500 will go dramatically higher. Meanwhile, we can see forward earnings per share in U.S. macro surprise index is relatively low, but the S&P 500 has broken away from that path and is really just correlated to the global liquidity proxy. So we're looking at the money supply. Here's a few more charts just illustrating the same thing. The more debt that's monetized by the Fed, the higher stocks go because it frees up banks to take profits on their bond positions and then go reinvest in stocks. And so this is clear as day. It makes our job a lot easier in predicting the big picture in these markets. Another example. Now in this we can see that the bank excessive reserves have been dropping rapidly over the last 2 years. And this is what's the cause of our repo madness. So the banks went from $3 trillion in reserves in 2015 down to $1.3 trillion currently. And so JP Morgan, Jamie Dimon are saying that they need, and Goldman Sachs are saying that they need to inject some $500 billion quickly into the Fed balance sheet to buy up all these bonds, which would represent gigantic profits for all these primary dealers, the banks, and that will free up their balance sheets. So that is quite likely to happen, especially if we get another crisis. Here's just something that puts you into the big picture of what's going on with the balance sheet. So you can see they tried to do some quantitative tightening and crash the stock market, bond market, gold market, every market. And now they're back to rushing to the printing press to monetize debt. And it's at a rate that's similar to the QE1, not quite as big as QE2 yet. And if we do look at this Operation Twist, that's where they just manipulate the curve on the bond market. So they just get rid of some of that short-term debt and buy up long-term debt. And so there's most likely a lot of QE ahead and slowly but surely dropping those interest rates. How long can they drag it out? Maybe 2 years, 25 basis points every 3 months. That's if we don't get the slowdown faster than expected and trade escalation with China. We go into a trade war with China and escalate it going into 2020. Most likely this whole timeline gets shortened and the Fed will be at zero sooner than we know it. The jump in U.S. bond yields last week was in the 99th percentile over the last decade. So not very often do we see the TLT sell off like that, and probably won't last for much longer, most likely 30 to 60 days max. And that's if everything goes hunky-dory with the stock market. CTAs are almost done selling bonds, while the market's great rotation is almost over. So we can see the CTAs have liquidated 78% of their position. How low could they possibly go? And we can look at some of these levels. So perhaps there is quite a bit of a sell-off still in the books for the TLT if, again, everything goes hunky-dory and there's no bad surprises. And it's just a funny cartoon riding the Type 3 mega market melt-up train. Magic ring, just buy the dip, Frodo. This is interesting. Although we have the federal funds rate going towards zero, credit card interest rates for consumers is not dropping. It's going up. And this does show that the banks are feeling like the consumer is becoming less and less creditworthy. And so we can see eventually this credit bubble will pop. Here's the euro assets of their central bank printing money alongside the Fed. Here's the Fed's injection of capital recently, and it's at a speed that's similar to this 2013 QE2, but probably more close to, well, the rate of change is certainly close to that 2013 level. The quantity is more similar to the 2009 initial QE. Okay, now we're moving into the political headlines. Republicans have requested a list of witnesses for the impeachment hearings. Now, in our boot camp, I did send you a Ukraine special update that covers every single person on this list to great extent. I'm talking 20 hours of content and of each of these characters. So we got Devon Archer, that's Jerry, John Kerry's stepson, who was partnered up with Hunter Biden, and the allegation against them is that sure, they're taking a bunch of money out of Ukraine, which appears to have been a big world money laundering scheme to the tune of $9 billion of U.S. taxpayers' money. And then you can go look at some of the other central banks who put money into Ukraine and can throw out another $3 or $4 billion from the IMF. Anyways, all of these folks have been turned down, so they won't get to be part of the public hearing. Schiff rejects GOP whistleblower testimony demand due to the president's threats. Nancy Pelosi, our inquiry has uncovered some profound betrayals of our Constitution, but it has also uncovered acts of profound patriotism by public servants who stood up for what was right. Now, this supposed whistleblower actually was working in Ukraine and is kind of like the accountant for the mob. He knows all the dirty details, so we'll see if they ever put him on the trial or not. Meanwhile, Trump is tweeting very rapidly about this, which means to me that he is concerned, and I think that's going to push him to give into a China trade deal. He can't fight China, fight the impeachment at the same time. And that's what I'm thinking at this point. So he's continuing to tweet away every day, almost every hour about this. Elizabeth Warren has a new competitor. One billionaire calls another billionaire and asks him to run for president. I'm shocked. Here's the deal. Companies like Amazon have too much power, and billionaires like Jeff Bezos and Mike Bloomberg should pitch in so that everyone can succeed. Bloomberg officially files paperwork for the 2020 presidential primary. I listened to a few interviews. This guy has donated more money to philanthropic causes then Trump's supposed net worth is times 5. So he's given away some $10 billion. Likes to balance the budget. I wonder if that'll fly with the Democrats. It may steal some of the vote from Trump for sure, but can he compete with Elizabeth Warren, who wants to blow out the budget and give everybody free money? Interesting. Also, this guy is the 9th richest person in America without being in a public company. So, that really makes him much more powerful than someone like Jeff Bezos, whose worth is really tied to stock valuations. His company is private, and he's made a fortune from selling Bloomberg terminals. His net worth is around $50 billion, so he's about 25 times more wealthy than Trump. And Trump's money is all in real estate value. So I don't know the exact financials for Bloomberg, but if we do look at what he did in New York to become mayor twice, he spent some $260 million to win those elections. So he's got the pitch for running for politics down. He's got the money behind him. He's got the support of many of these big tech giants. Can he beat Elizabeth Warren? We'll see how he performs. Trump's already out calling him a short guy, which I think is slowly but surely leaving a bad taste in people's mouths, that Trump continues to belittle his opponents, although it worked in the last primaries. I'll never forget him calling Mark Rubio the little guy over and over and over again in the debates. Meanwhile, Morgan Stanley is saying Microsoft could buy Bloomberg Terminal business if Mike progresses in the primaries. That would put him in a huge cash position. So all of a sudden he would potentially have more money to blow at the election process. Now, Democrats are not happy about this and look at it as a blow to Joe Biden. And in his most recent interview, actually, with, I think it's with Bloomberg. I'd have to double check who was interviewing him. He goes out and says this is ridiculous. They're not going to impeach the president. 65 million people voted for him fair and square. So this is kind of a bash to Nancy Pelosi and the Democratic Party. Now, what is confusing about Bloomberg is he's been switching his from Republican to Democrat back and forth. So we'll see how this all plays out. I don't know a whole lot about him yet. The big picture is that America's richest 1% are wealthier than the middle and lower classes combined. And every time in history when this gets out of proportion, the populist movement comes, they change the laws, and they rip that money right out of the rich folks' hands. And they are scared to death. They know their history very well. And so that's why you got people like Elizabeth Warren kicking ass, taking names, whether it's good or not. Let's be clear, when private equity firms acquire companies, suck out all the value they can, and walk away rich, leaving workers, their families, and their communities suffering with the consequences, it's legalized looting. I have a plan to end it. This is the supposed whistleblower. Facebook is getting beat left and right. Should they be censoring content? Should they not be censoring content? He went and did a big speech saying that they won't censor political content. And now they're getting pressured to scrub all references to this whistleblower. And again, this guy is a pivotal part in the whole storyline. If you watch that Ukraine special, all of the people on their list are on there. They probably all saw the same content. And so that is a wrap for today's update. I do want to remind you, if you go to the description box, register for our webinar Thursday. I have an hour-and-a-half presentation. It's pure content. Goal is to teach you how our strategy works, how to predict the big moves in the market, and then how to use options to really mute the volatility and aim for a very steady retirement income with low downside risk. And also to weatherproof you for what's coming. And so, if you think this stock market has a lot longer to go higher, and the bond market for that matter as well, you got to realize we're at the end of the rope. This just can't go any lower. They can drop it to zero. They can print a couple $1 trillion, and then you get inflation, and you get a period like 1965 to 1980 where people's portfolios get wrecked. And so be prepared. Join our webinar. Thank you, everybody. Tomorrow we'll close out our emerging markets trade, and that's a wrap. Thanks.